Welcome, curious minds, to The Deep Dive. Today, we're doing something a bit like time travel. Picture stepping back right into 1989, a really pivotal year, not just globally, but for one company, the Markel Group, which was sort of quietly laying the groundwork back then.
Oh, absolutely. The 1989 is a fascinating point to look at for Markel. That year's shareholder letter, it's almost like a blueprint. You can really see the foundations they were building for the long run.
Exactly. And that's our mission today, right? To pull out the really key insights from that one document. Think of it as maybe your shortcut to understanding Markel's early game plan, the hurdles they faced, and it was a competitive time, and the long view they already had. We're looking at the late 80s financial world through their lens.
And it was a dynamic landscape back then. You have to remember, the late 80s, lots of change happening. Huge opportunities, sure, but also significant challenges, especially in insurance. Knowing that context really helps you appreciate Markel's moves, which, frankly, sometimes went against the prevailing trends.
Okay, so let's jump right into the scorecard. How did Markel actually do in 1989? The letter calls it their 88th and eventful year, but despite bumps, they said it was a time of good results. Overall goals met, even if, not every single part of the business hit its specific target.
Yeah, and what's really striking is how clear their financial goals were even then. They were explicitly aiming for 20% annual growth in revenue and a 20% return on shareholders' equity. And for 89, they pretty much hit that. That's pretty ambitious stuff for the market they're in.
And some of the numbers really pop out. Total operating revenues up an impressive 24%, hitting, wow, $606.8 million. That's a big jump.
It is. And importantly, it wasn't just, empty revenue. Net income also climbed 24%, reaching $13.43 million. And net income per share up 12% to $2.60. So shows discipline, right? Growth was actually flowing through the bottom line, benefiting shareholders.
So shareholder value was climbing nicely too. That return on average shareholders' equity stood strong at 20% for a year. And if you look back over the previous 5 years, they'd actually done even better, like 30% revenue growth and 30% ROE. It really shows that ambitious compounding mindset was already there.
Compounding. And if you connect the dots, you see this company rapidly building its base. Shareholders' equity, which is, the real measure of owner value, it grew massively from $6.7 million end of 85 to $38.7 million by the end of 89. Book value per share, $1.24 to $1.96 in that time. These aren't just numbers. They show real capital compounding for the owners.
But what's the lesson here for us today, looking back at these early numbers? I think it's that Markel was like hard-coding financial discipline and that focus on shareholder value right into its DNI from early on. These aren't just stats. It's almost a masterclass. They weren't just getting bigger. They were accretively growing that equity per share. That's a powerful thing many companies still miss today.
Absolutely. They got it.
Yeah.
Sustainable value comes from both growing the pie and making sure each slice gets proportionally bigger for the owners, not just chasing those vanity metrics on the top line.
Okay, so the overall picture looks good, but what was behind that growth, especially when we start, peeling back the layers on their main business underwriting? The letter mentions their philosophy, disciplined standards, focusing on unique niches.
Right. And this is where it gets, really interesting, especially that combined ratio. Now, their main insurance companies, Essex and Markel American, they had a great 5-year average combined ratio, like 86%. But for 1989 alone, it was 109%.
Whoa, 109%. That's quite a jump from the average. In a tough year like that, wasn't there huge pressure to maybe, loosen up standards a bit, just write more business to get premiums up? How do you think they resisted that?
That is the million-dollar question, isn't it? And it tells us a couple of crucial things. First, it shows just how tough that insurance market was, really competitive. A combined ratio over 100 means basically you're paying out more than you're taking in for that year. Ouch. But second, and maybe more important, despite that headwind, their stated focus, we're right there in the letter, stayed locked on sound underwriting and gradual investment. It really speaks volumes about their long-term discipline, even when the short-term numbers weren't pretty, like a marathon runner, right?
Yeah.
Not sprinting early, Markel was playing the long game.
Yeah, it makes you think. Facing 109% combined ratio, how many others would have stuck to their guns like that? It's a real signal of conviction, refusing bad business just for the sake of volume. Okay, so moving on, their brokerage side was also growing. October 89, they bought assets from the Rulin Agency. Looks like the goal was new niches, stronger national presence.
Exactly. And here's where their transparency really shines through, I think. They point out that brokerage is seasonal, right? Most revenue in Q2 and Q3. And they openly say the Rulon division, being new, actually lost money in Q4. It cut earnings by $0.14 per share. Being that upfront about a specific quarterly hit from a new acquisition, that's pretty remarkable for a 1989 letter. It wasn't just transparency. It feels like a strategy to build trust, saying, look, we're in this for the long haul, warts and all.
That is powerful communication. And meanwhile, Lindsay, their municipal liability unit, kept leading, plus they bought some business from Special Risks, Inc.
So clear strategy, expand expertise in specialized area.
It wasn't just random growth, it was targeted. Moving into complex areas where their know-how could, give them an edge. Okay, beyond underwriting and brokerage, claims administration, Lindsay and Newsom. Expanding there too, 22 offices, 36 states, becoming a major player. But what really jumped out at me was that quote about their philosophy. First will be the best, then will be first. What does that really tell us about how they saw reputation versus maybe short-term profit, especially when margins were tight?
Oh, it tells you everything about their values, I think.
Right.
It's not just the slogan, right? It's a deep commitment, quality first, then scale. And despite the catastrophes of 1989, which must have hammered claims, the letter's quite frank that profit margins and ROI were lower than they wanted, and they expected that to continue into 1990. So even with that be the best ethos, market reality was biting, and they owned up to it.
It really paints a picture of a company dealing with real-world stuff, but staying, well, fiercely true to its values in the long game. And lastly, on the business side, strategic partnerships. Shan Evanston Group, Frank's Financial, they got shout-outs for exceptional investment performance.
Yeah, and what's cool here is the specific mention that these partners, plus Essex Insurance's own equity stuff, were all managed with a disciplined value orientation by Hamblin Watts Eye Investment Counsel. It explicitly links their investment philosophy across the board, showing consistency.
And the letter stresses, each unit operates on its own, but they all contribute to the group's overall strength, especially important for that new Rulon business they just brought in.
So what's the big takeaway here for you listening? Yeah, I think it's seeing a company grapple with, tough market stuff, that 109% combined ratio, the Q4 loss in the new brokerage unit, but staying incredibly true to its long-term plan and values. They weren't just thinking quarter to quarter, they were building something solid.
Exactly. That contrast, the openness about the loss, it's a great example of facing challenges head on, but staying transparent and committed to principles, not just for a year, but, for the long haul.
Yeah, it says a lot about the leadership's character and foresight back then.
So, okay, pulling it all together, what does this mean for Markel's financial strength and their investment approach? That main goal comes up again and again. Earn 20% on equity and keep a really strong financial footing. That consistency alone tells you something about their discipline.
And they were definitely building that strength. Total assets grew quite a bit in '89 from $147.3 million up to $195.7 million. Real tangible growth, providing a solid base.
And the investment portfolio, that grew substantially too, $31 million to $66.5 million. And the letter's clear. Most of that was in high-quality fixed income, bonds, basically.
Yeah, pushed to a pretty conservative yet growth-minded investment style. The goal, they said, was balancing opportunities, prioritizing better returns, but always with a laser focus on high quality. No chasing wild speculations, just prudent capital compounding.
And even while navigating those operational issues like the tough insurance results, the market seemed to get it. The stock price graph they included shows a nice upward trend through '89. That's kind of a validation, isn't it? Even in a tough year.
It absolutely is. And that approach, prioritizing quality and stability in investments, not giving in to short-term panic. Well, that's a lesson still super relevant for investors today, right? It shows prudence and growth aren't opposites. They actually work together really well. It's about discipline, a long view, avoiding fads, focusing on fundamentals.
So let's recap our deep dive into Markel's '89 letter. It was definitely a year of strong financial growth overall, strategic moves, but set against a really challenging market backdrop. We saw this clear, almost stubborn commitment to disciplined underwriting, smart expansion, and a solid, quality-first investment philosophy running through everything. And that honesty, talking openly about successes and setbacks like the Q4 brokerage loss or the high combined ratio, that builds serious long-term credibility.
It wasn't a puff piece.
Yeah.
It was a serious letter about strategy and execution in a tough year. They were building something for the decades, not just the quarter, by sticking to principles that, frankly, take courage when things get bumpy short term.
Right. And maybe here's a thought for you to take away. This look back in 1989 isn't just Markel history. It's kind of a window into these timeless principles for building a resilient business, one that compounds value over the long haul. So, what lessons can you maybe pull from how Markel balanced those big, ambitious long term goals with the messy, immediate challenges of a specific tough year? How does seeing that history maybe shape how you think about growth, discipline, and communication today?
Yeah, definitely something to chew on as you think about your own strategies, whether it's business, investing, or even just setting personal goals. That long view, it can really make a difference.
Exactly. Until next time, keep digging deeper.